The world's largest silver exchange is sitting on a contradiction that is getting harder to ignore. Right now, COMEX has approximately 103 million ounces of silver officially available for delivery. At the same time, in less than a single month, the exchange is facing more than 400 million ounces of open silver contracts that could potentially demand physical metal. The comparison is simple. It's like having 100 pizzas prepared while 400 hungry people are about to show up for dinner. On paper, the system works only because most people don't actually eat. They just look at the menu, pay, and leave. But the moment too many people ask for the real thing, the math collapses. The most important date in this story is February 27th, the first notice day for March delivery. That is the day when contract holders must declare whether they want cash settlement or physical silver. As this is being recorded, that date is less than 2 weeks away. And while the clock is ticking, COMEX vaults are draining at a rate of about 785,000 ounces every single day. Not per week, per day. When you put those numbers together, it becomes clear that something has to break. Whether you already own silver, are considering it, or simply want to understand how the financial system really works, what happens over the next 30 days could reshape metals pricing for years. And this isn't just a precious metals story either. Silver is essential for modern technology. You cannot build advanced electronics, energy systems, or artificial intelligence infrastructure without it. To understand why the situation is so dangerous, you first need to understand what COMEX actually is. COMEX is the primary futures exchange, where silver and gold contracts are traded. But COMEX is not a physical marketplace in the traditional sense. It is a paper market. Most participants never touch real metal. They trade promises. And the entire system depends on one assumption. Only a tiny percentage of traders will ever demand physical delivery. Let's talk about something the mainstream financial media is completely ignoring: the silent, ticking time bomb in the silver market. Most people look at the total silver inventory at the COMEX and think everything is fine, but they're missing the most important detail, a detail that changes the entire picture. You see, COMEX silver is split into two categories: registered and eligible. Registered silver is the metal that's actually available to be delivered against a futures contract. It's the real usable inventory. Eligible silver, on the other hand, is just silver being stored in the vault for private owners. It's not for sale. It's like looking at a car dealership slot and counting both the cars for sale and the customer's cars in the service department. Only the cars for sale actually matter to a potential buyer. So what happens when we look at only the registered silver, the metal that truly counts? The numbers are shocking. Right now, registered silver is hovering around 103 million ounces. That sounds like a lot, right? But hold on. This is a staggering drop of nearly 70% from its peak in 2020. The inventory that backs the entire paper market is vanishing at an alarming rate. And the speed of these withdrawals is not just increasing, it's accelerating into overdrive. To give you some perspective, in the single month of January 2026, a massive 50 million ounces were pulled from COMEX vaults. Let that sink in. Just a few years ago, we might see less than 7 million ounces withdrawn over an entire year. What we are witnessing isn't a minor fluctuation. This is not normal market behavior. This is a sign of deep structural stress. The foundation of the paper silver market is crumbling, and very few are paying attention. This isn't just a New York problem, it's a global phenomenon. The strain on physical silver supplies is showing up everywhere. Let's look at Shanghai, one of the world's most important physical metals hubs. Silver inventories there have plummeted to their lowest level since 2016. The well is running dry on a global scale. And what happens when supply gets this tight? Premiums explode. In many Asian markets, buyers are desperate. They are paying premiums of $30 to $40 over the spot price just to get their hands on physical silver for immediate delivery. Think about that. The official paper price might say one thing, but the reality on the ground, where real metal trades hands, tells a completely different story. While the paper market projects an image of calm, the physical market is in a state of chaos. There's another flashing red light that almost everyone is missing: the silver lease rate. This is a critical indicator of stress in the wholesale market. A lease rate is essentially the interest rate that institutions pay to borrow physical silver. Normally, this rate is incredibly low, often less than 0.5%. It's usually a quiet, boring corner of the market. Not anymore. Today, silver lease rates are spiking, recently hovering near 8%. An 8% cost to borrow physical metal is unheard of. It's a sign of extreme desperation. Why would major institutions pay such a high price? Because they desperately need physical silver and can't find it anywhere else. They are willing to pay almost anything to avoid a delivery default. Markets simply do not behave this way unless there is a genuine, severe shortage of the underlying physical commodity. The message is crystal clear. The available supply is tight, and the sense of urgency is real and growing. So let's connect the dots. We have registered inventory at COMEX collapsing by 70%. we have an unprecedented acceleration in the pace of withdrawals. We see inventories in major global hubs like Shanghai at multi-year lows. We have physical premiums in Asia going through the roof, and we have wholesale lease rates screaming that there is a severe shortage of metal. Each of these is a major warning sign on its own. Together, they paint a picture of a market on the brink. The disconnect between the calm paper price and the chaotic physical reality has never been wider. The paper market is a promise, a claim on a physical ounce of silver. But what happens when everyone wants to redeem that promise at the same time, and the physical metal simply isn't there? We are seeing a classic setup for a massive short squeeze, but on a global scale. The forces that have suppressed the silver price for decades are losing control. The physical demand is overwhelming the paper supply. This isn't speculation, it's an analysis of the available data. The numbers don't lie. The vaults are being drained, the premiums are soaring, the lease rates are signaling a 5-alarm fire. While most of the world is distracted, a historic repricing of silver seems not just possible, but inevitable. The question is no longer if, but when. The physical reality is asserting itself, and it's telling us that the true value of silver is far higher than the current paper price suggests. This is a story you need to follow closely. Thanks for watching, and be sure to subscribe for more updates as this situation unfolds. We've arrived at a critical moment for the silver market, a pressure point that could change everything. The March COMEX silver delivery. The numbers tell a story that's hard to ignore. Right now, we're looking at roughly 400 to 500 million ounces of open interest in silver futures contracts. Stacked against that, the COMEX registered inventory, which is the silver available for immediate delivery, holds just 103 million ounces. Let's break down what this imbalance really means. If just 10% of those contract holders decide they want the physical metal, not just a paper settlement, they would need to take delivery of over 50 million ounces of silver. That's nearly half of the entire registered supply, gone in an instant. Now, what if that number doubles? If 20% of contract holders stand for delivery, that demand would be over 100 million ounces, potentially wiping out the entire registered stock at the COMEX. This isn't some far-fetched fantasy, it's simple math based on the current situation. What makes this scenario particularly tense is the recent behavior of the market participants. The delivery participation rate has been extraordinarily high, hovering near 98%. This tells us that almost everyone who is in a position to take physical delivery of their silver is doing so. They are choosing metal over cash. These aren't small retail investors making a statement. We're talking about major players, large institutions, investment funds, and industrial users. These are the insiders, the entities that understand the mechanics of the futures market better than anyone. Their actions signal a profound shift in sentiment. They are demonstrating that they no longer trust the paper promises that underpin the market. They want the real thing, and they want it now. So why this sudden rush for physical silver? The answer lies in what's happening outside the futures market, in the real world. Physical silver is becoming incredibly scarce. Go ahead, try to buy large quantities from dealers. You'll be met with delivery delays stretching not just weeks, but months into the future. This is a huge problem for industrial users, who are the backbone of silver demand. Think about the sectors driving our modern economy: solar energy, electric vehicles, consumer electronics, and the booming field of artificial intelligence. All of these industries require silver, and they can't afford to wait. Their production lines depend on a steady, reliable supply of metal. They need it now, not in 3 or 4 months. For these large consumers, the futures market, specifically COMEX, might be one of the last remaining avenues to secure significant quantities of silver quickly. They can buy a contract and stand for delivery, bypassing the long waits and uncertainty in the retail and wholesale markets. This desperation from industrial users is adding a new layer of pressure on an already strained system. If this intense demand for physical delivery continues, the COMEX will find itself backed into a corner with only bad options. Let's consider their playbook. They could try to force a cash settlement, essentially telling contract holders, "Sorry, we don't have the metal, here's some cash instead." This would be a catastrophic move. It would shatter the illusion that the futures market is a reliable source for physical commodities and would destroy confidence overnight. It would be an open admission that the paper market is disconnected from physical reality. Another option would be to change the rules mid-game. They could increase margin requirements, limit position sizes, or introduce other emergency measures to try and force speculators out of the market. But this would be a sign of pure desperation. It would send a clear signal to the world that they have lost control and are simply trying to survive. It wouldn't solve the underlying problem, which is a lack of physical metal. Their classic move is price suppression. By using massive paper sales, they can try to slam the price down to shake out weak hands and discourage buyers. We've seen this tactic used countless times. It might work temporarily, slowing the momentum for a day or two, but price manipulation cannot create physical silver. It can't fill empty vaults or speed up mining operations. It's a short-term fix for a long-term structural problem. We've seen similar showdowns in the silver market before, most famously in 1980 with the Hunt brothers and again during the price spike in 2011. But there's a crucial difference this time around, a difference that makes the current situation far more precarious. The vaults are nearly empty. In previous squeezes, there were large known stockpiles of silver that could be brought to market to meet demand and break the squeeze. Today, those stockpiles are gone. For more than 5 years straight, the silver market has been in a structural supply deficit. This means the world has been consuming more silver than it has been producing. On average, this deficit has been around 200 million ounces per year. Over 5 years, that adds up to a cumulative shortfall of close to 1 billion ounces. That's 1 billion ounces of silver that has been drawn down from above-ground inventories to meet demand. Those inventories are now at dangerously low levels. And don't expect the supply side to come to the rescue. Bringing a new silver mine into production is a long, expensive, and difficult process that can take a decade or more. Mining output simply cannot respond quickly to a sudden surge in demand. Meanwhile, the demand isn't cyclical, it's structural. The green energy transition and the technological revolution are not fads. They are long-term trends that will continue to drive silver demand for years to come. We have structurally rising demand hitting a wall of constrained supply. So, what should you be watching now? The key events are happening right in front of us. First, keep a close eye on the number of contracts that remain open and stand for delivery after the notice period begins on February 27th. This number will tell us exactly how much physical demand is hitting the COMEX this month. Second, watch the COMEX registered inventories daily. See if they continue to decline and how quickly. Any significant drop is a major red flag. Finally, pay attention to silver lease rates. Rising lease rates indicate that it's becoming more expensive to borrow silver, a classic sign of tightening physical supply. Markets like this don't usually collapse with a loud bang. The process is quieter, more insidious. The system tightens, liquidity dries up, and the spreads widen. It tightens and tightens until one day it just snaps. What we're witnessing is not chaos. It's the orderly, logical progression of a system approaching a physical limit that it was never designed to handle. The paper market is about to have a very real encounter with the laws of supply and demand. The next few weeks could be historic. Make sure you're paying attention. Thanks for watching. And be sure to subscribe for more updates as this story develops.